This is Horizon's Middle East and Africa. Our top stories this morning. Risk-off mood. Stocks and futures fall with the dollar near two-month lows ahead of key U.S. economic data. Gold and Bitcoin also dropping on weaker sentiment. The U.S. offers Kyiv significant security guarantees, but the effort still appears to pressure the Ukrainian president to give up land. President Trump says an end to the war is closer than ever. Plus, the Nasdaq seeks approval from the SEC to extend trading to 23 hours on weekdays with an expected start in the third quarter of 2026. It's just gone past 9 a.m. across the Emirates, 7 a.m. here in Cape Town. I'm Jennifer Zabasaja in for Jumana Bersetchi, and we have been talking about for quite some time a lot of economic data, a deluge of economic data that we're waiting for this week, some of which is going to come today. It is a very important day for markets with the very delayed November jobs report that is set to be released in the U.S., as well as the establishment survey from October. Markets keenly awaiting those two reports, and we're seeing a bit of a risk-off mood taking shape, permeating throughout the markets, as you can see on the board here, just ahead of that release. If we take a look at U.S. equity futures, continuing to track lower, extending losses from Monday, we saw all of the major indices closing lower, again, mostly off the back of some of that weakness that we're seeing again in tech and on the AI trade. S&P futures down just about 0.4% there. That also feeding into losses seen in the Asia session, but we'll have Min in just a few minutes get to that as well. We're seeing that also, some of that weakness also playing out in currencies. If we take a look at what we're seeing with the price action as far as the dollar goes, we have dollar yen on the board right now, with the yen gaining some ground against the dollar. As you can see, they're tracking just below 155 level. And of course, we mentioned this week is a very important week for central bank activity, with many people anticipating that BOJ decision on Friday, where policymakers are expected to hike. So we're watching closely what that pair and how that pair really shakes out as we get some of this economic data and some central bank activity. Bitcoin also falling alongside some of the other risk assets broadly today, dropping below 86,000 there for the first time in 2 weeks, down over 0.4% there. A key level to watch will be 74,400, which is where we saw the cryptocurrency fall to a 2025 low back in April, and Brent crude down just about 0.5% there. And let's bring you our terminal chart. I mentioned Brent crude is down. We are seeing both Brent and WTI weaker there. And really the question is, what does this discussion around a potential ceasefire between Ukraine and Russia mean for oil, especially if we continue to talk about a supply glut and potentially what this means for supply and demand dynamics, and what many analysts are anticipating is already an oversupplied market in 2026. That is what we are looking at right now as this chart is showing. Let's zoom in, though, on how markets in Asia are faring. I mentioned Min Lo is in our Hong Kong studio with a bit of a closer look there. Min, I see quite a bit of red on your board there. Dig into that for us.
Yes, Jen, we are seeing quite a bit of cautiousness as we look towards the end of the year and looking ahead to that jobs data from the U.S. as well, expecting to see some sluggishness from the jobs report. And here you can see it looks like we are not set up for the Santa Claus rally towards this year end, because we're seeing big declines to the tune of almost 2% on the Hang Seng, the Kospi as well, down by 1.6%. A part of it is also profit taking from some of the better performing sectors so far. And again, that concern over the AI bubble still reflected in the markets as well. But we are zooming in particular into the Chinese market, because we saw a big sell-off onshore. We are watching for correction for some of these indices. The MSCI China now breaking below the 82 level. If we continue to close at these levels, we would be in correction by market close. The same thing for the Hang Seng China as well, below 1.9%. That marks a 10% lower from the October high. So if this momentum continues, again, the Hang Seng China shares also could be in correction by end of the day. And of course, this is partly because of what some economists are calling the ugly November data that we got yesterday, and increasingly a growing chorus of economists calling for China to strengthen the yuan to rebalance the economy. On state media as well, there was articles publishing basically the speeches that President Xi has made over the past decade or so, highlighting the importance of growing domestic demand, but the focus still very much on the supply side reform rather than the demand side. And I think some analysts are a bit underwhelmed by the signals from the government regarding stimulus policy so far.
Wow. Thanks so much, Min Min Lo in Hong Kong. We'll check back in with you in just a bit. Thanks for that update. Let's stick on central bank policy, though. Fed Governor Stephen Miron says the central bank's policy stance is unnecessarily restrictive based on his benign outlook for inflation and warning signs in the labor market.
There was a large bout of inflation that resulted in an increase in prices after the pandemic. While American families are still rightly distraught with that experience and unhappy with affordability, prices are now once again stable, albeit at higher levels. Policy should reflect that. Experience suggests that labor market deterioration can occur quickly and non-linearly and be difficult to reverse. In part because monetary policy lags several quarters, a quicker pace of easing policy, as I have advocated, would appropriately move us closer to a neutral stance.
Joining us is Deepak Mehra, Chief Economist at the Commercial Bank of Dubai. Deepak, thanks so much for being with us. Let's just start on this data point. We just heard Min Min there talking about what some people classify as that ugly November data from China. We're also keenly awaiting for some of that data, delayed, incomplete data in the U.S. Considering this is delayed and backward looking, how significant do you see this jobs print for the Fed and also for the outlook for policy moving forward?
Good morning, Jennifer. Yes, absolutely. It looks rather ugly so far because, one, we did not have data for almost 2 months. And now we have a deluge of data, which is also not current. And this data that we're getting is also stale. And not only that, it's partial. For example, today we will see October non-farm payroll print as well, but it will not carry the entire report. And then we will see the November data, which is delayed. We are not even sure of the quality of data because the government just reopened some time back. So there will be not just a deluge of data, but deluge of data which is stale, incomplete, and maybe confusing at times. So I think we are set for volatility as more of this data gets released, not just today's non-farm, but we have today retail sales as well. And then we have later in the week the CPI, delayed CPI data. Now, most of the Fed focus is on payrolls right now, and that's why we're getting rate cuts. So payroll data becomes very important. But let's see what we get and how does it look. So it has a lot of ramifications on the January rate cut, which is still up in the air. The Fed did not close the door for that rate cut, but we have to go by the data.
And yet, Deepak, you mentioned in your notes that you still see Fed-related volatility settle, despite some of the volatility that we're seeing right now, a more divided FOMC in 2026 and potentially leadership changes. What leads you to this conclusion? When will we actually see this volatility actually settle?
So I think the whole of H1, first half of next year, we're going to see some sort of volatility. It'll be either because of data or because of the constitution of the Fed. Remember, February, we have all the 12 regional Fed presidents coming up for reappointment. And then somewhere in Jan-Feb, we'll also get the name of the new Fed chair. Is it Kevin Hesed or is it Kevin Walsh? And then May, the Fed actually, the chair actually changes. So during all this period, you have Fed-related uncertainty and data-related uncertainty. And not to forget that we have AI-related questions as well in the market. So I think things will settle possibly in the second half of next year.
And you say, we'll see the broadening out away from just AI. Where do you think the impact then on AI or on the economy, excuse me, will be from AI? Does that still leave the Mag 7 with the same dominance that we're seeing it have right now?
Yeah, I think that's a good point. The big theme of 2025 was concentration in these top Mag 7 or 10, 12 stocks. And the big theme in 2026 will be broadening out of the AI story. So from pure infrastructure play, AI is going to move into application space. And that's where many more companies are going to benefit from AI and applications of AI. And so that will have a very broad impact on overall S&P index, whether, we look at definitely at industrials, financials, and healthcare possibly being the biggest beneficiaries to begin with, along with every other sector going forward. But yeah, these three sectors stand out. And for us, the best play would be go index rather than trying to pick stocks, because it'll be very difficult to pick up winners and losers as this AI story progresses further. The story has a long way to go. The hyperscalers will still have the balance sheet to continue to dominate, but it'll broaden out. That'll be the big story for 2026.
Deepak, let's just finish on bond. How much do you worry about potentially the return of bond vigilantes in this current environment?
Yeah, that is, Jennifer, that remains one of my biggest worries for 2026, that if for whatever reason inflation remains sticky and the Fed goes for aggressive rate cuts, either due to labor market data or due to political pressures, then you will have the bond vigilantes coming out and punishing, especially the long-end treasuries, and that could have the yields shoot up once again. I don't think they're getting unhinged, but yeah, it is a risk that they start rising, and that could then derail the equity markets at some stage and the entire risk appetite in the market. So that remains one of the key worries, key risks for 2026, first half at least.
And potentially threatening a Goldilocks scenario, as you say. Deepak Mehra, Chief Economist at Commercial Bank of Dubai. Deepak, always great to speak with you. Thanks so much for joining us this morning. Now, for a look at some of the other stories we are following today. President Trump is suing the BBC for $5 billion over a misleading edit in a documentary last year. The clip gave the impression he had made a direct call for violence in a speech leading up to the January 6, 2021 attack on the U.S. Capitol. The BBC has since apologized for the edit, but has rejected Trump's demand for compensation. Now, coming up, U.S. negotiators offer Ukraine Article 5-like security guarantees as part of a deal to end the war. We have all the details on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Cape Town. U.S. negotiators offered Ukraine Article 5-like security guarantees as part of its deal to end the Russia-Ukraine war. But President Trump suggested Ukraine ought to give up land as part of the deal.
I think we're closer now, and they will tell you that they're closer now. We had numerous conversations with President Putin of Russia, and I think we're closer now than we have been ever.
With me now is Tony Halpin, who leads Bloomberg Russia Economy and Government Reporting. So, Tony, the U.S. now offering these Article 5-like security guarantees. Do we know if this is enough to stop future Russian aggression? What more can you tell us?
Well, everyone was sounding very upbeat after the latest round of talks about the prospects for some sort of deal to bring this war to an end. But there's still a lot that we don't know. Article 5-like is a rather vague term so far. Article 5 is very clear. An attack on one country in NATO is considered an attack on all the others. Article 5, like the US has said it will offer Ukraine, but President Trump has also said previously that there'll be no US troops on the ground in Ukraine. So it's not quite clear so far how that will work. European leaders were saying that they were ready to commit to Ukraine's defense as well, and they were offering assurances about a response if there was a future Russian attack. But there too, they are saying that that may include an armed response, but also economic and diplomatic measures. And it's this sort of vagueness that Ukraine has been very wary of signing up to because they've had bad experiences in the past. So far, there's still a lot of questions, I think, to answer about what kind of security guarantees President Zelensky of Ukraine will get in return for a deal that may end up conceding some land.
Right. And Tony, we were just hearing there from President Trump sounding optimistic, as you say, that a deal is closer than ever, but still suggesting potentially Ukraine needs to give up land. It seems like the goalpost is moving with when, in fact, we'll actually get a deal. What is inevitably going to happen? What, based on your reporting, do you think where are we at right now?
Well, the big unknown currently is what Russian President Vladimir Putin's response to all this will be. It's fine to say that a deal may eventually be reached involving Ukraine, the US and Europe, but it takes two to tango, and we just don't yet know what Russian President Vladimir Putin's response would be to any sort of agreement. He has all along maintained maximalist positions. He's demanding large areas of land in eastern Ukraine. He's demanding that Ukraine never joins NATO. And he's demanding lower limits on the size of Ukraine's army than is currently included in the proposed discussions in Europe. So it all comes back to really Putin's view, Putin's response. He's the one who started this war. He's the one who can stop it tomorrow. But eventually, he's going to have to respond to whatever proposals are agreed upon in Europe and which the US supports. So far, we don't know what that response is.
Tony Halpin, who leads Bloomberg Russia Economy and Government Reporting. Tony, thanks so much for the update on those talks. Appreciate it. Now, the EU's top trade official has told Bloomberg TV China has started granting critical minerals licenses with lengthier terms. The move is set to help European companies to obtain the minerals essential for industries, including clean tech, automakers, and defense contractors.
I think we are getting initial reports from our industry that they are getting these general licenses, but we need to have a little bit more granular information to evaluate the whole process. But the fact that this idea was favorably received, that it seems that we are getting first general licenses, and also that the Chinese side was receptive to our arguments that the process as it was set up in April required too much of I would say, very intrusive information, too many photographs, too much detail about the supply chains, and I think that the general licensing could be one of the solutions how to address this issue.
Now, from Europe to Africa, coming up, Ivory Coast steps in to stabilize its cocoa sector as exporters face mounting losses. We'll bring you that story next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Cape Town. Ivory Coast is stepping in to stabilize its cocoa sector. The government has authorized its industry regulator to buy about 200,000 tons of beans from farmers as falling international prices have left local exporters saddled with losses. For more, let's bring in Bloomberg's Andira Oganga, who joins us now from Kigali, Rwanda. So, Andira, what is driving the glut in the cocoa market that is now forcing the government to step in and actually mop up some of this excess supply? Give us a rundown of that.
Good morning, Jennifer. So if we look at last year, cocoa futures hit a record high. Then fast forward 12 months later, this year prices have reduced by nearly 50%. Then you pivot that prices and you couple it with facts that there's expectation of better harvest and also signals of softer demand. You have this conundrum that Ivory Coast is currently facing. You have exporters that are locked in and had promised to buy some of these future contracts at higher prices, and they're buying into a falling market. Then you have a government that had promised farmers higher farm gate prices to protect their income. And when you put all this together, you have a mismatch in contracts, and they've gone from being assets into being liabilities. And the problem of exporters do not stop there. They depend on lines of credits. With prices falling, banks are reassessing, and they're being more hesitant in lending out credit. Now, this credit is the lifeline of the value chain in cocoa. They're responsible for buying, storage, shipment. And when you take that away, production of cocoa beans still continue, but they can't be financed. And that's the reason why we were seeing these trucks piling up in the ports in San Pedro and Abidjan. And you have exporters now just skirting around trying to look for buyers of these beans. You also have farmers who are now doing fear selling. They're harvesting as much as they can because they fear that the government might change the farm gate prices. And you put all these factors together, you have a government that is saying, let's buy up these excess beans from the market. And once things stabilize, we will offload them back to exporters, but not in a rushed manner.
Not something that the biggest cocoa exporter in the world wants to be facing with. But what does this mean for others who are potentially sitting globally around the supply chain, and also those maybe heading into the festive season looking for chocolate?
Jennifer, when you look at it on the surface, it looks like there's oversupply, but markets are still recalibrating. This is not a market glut. This is just shock waves in prices that are leading to this situation where we are seeing the illusion of oversupply of beans in the market. There's still fundamental problems in the production cycle of cocoa. Some regions are still undersupplying their beans. They're dealing with problems such as diseases, old trees, costly fertilizer, pesticides, illegal mining, and climate change. And so one good production cycle because weather was favorable and farmers were able to get a little bit more from the prices last year does not mean that it will solve the fundamental problems that have been affecting the cocoa production industry. And you take that and you translate it into the global market. Last year, the prices were very volatile, and you have manufacturers that are still trying to repair that. You couple that with production prices like energy, labor, logistics, and prices are likely to remain slightly elevated, at least through this Christmas cycle. So it's going to take a toll on the pocket, but as Lizzie says, it's good for the waistline.
Good for the waistline. Not sweet, Ndiro. But thanks for that report. Bloomberg's Ndiro Oganga in Kigali, Rwanda with that report. Ndiro, thanks so much for that. Now, for a look at some of the other stories that we are following in the region, Nigeria's inflation eased more than expected in November, dropping to an annual rate of 14.5%. The slowdown and expectation that price rises will keep cooling may give the central bank room to restart interest rate cuts in February. Economists say a temporary jump in December is expected due to a new CPI base, but should be a one-off effect. And Zambian lawmakers have approved changes to the constitution that alter the composition of parliament just 8 months before national elections. The parliament passed the amendment bill, expanding the assembly from 167 to 280 members. Government critics have opposed the changes, describing them as an attempt by the president to secure a majority for his ruling party. Coming up, we'll stick in South Africa. South Africa is set for its biggest overhaul of its cash system in decades. We go live to Johannesburg next. This is Bloomberg. This is Horizons Middle East and Africa. Our top stories this morning. Risk-off mood. Stocks and futures fall with the dollar near 2-month lows ahead of key U.S. economic data. Gold and Bitcoin also dropping on weaker sentiment. The U.S. offers Kyiv significant security guarantees, but the effort still appears to pressure the Ukrainian president to give up land. President Trump, though, says an end to the war is closer than ever. Plus, Nasdaq seeks approval from the SEC to extend trading to 23 hours on weekdays with an expected start in the third quarter of 2026. It's just gone past 9:30 a.m. across the Emirates, 7:30 a.m. here in Cape Town. I'm Jennifer Zapasaja in for Jumana Bersechi, and it is an economic deluge that we are getting this week, and many traders are anticipating that much delayed jobs report that we are getting in the U.S. And as you can see, a bit of a risk-off mood is taking shape throughout throughout the markets, continuing to extend some of the losses that we did see on Monday, extending, those losses that we saw from the close of many of those U.S. indices, extending into Asian trading. As you can see, S&P futures down just over 0.5% there. At the close on Monday, a lot of what was continuing to put pressure on some of the tech names were AI names, continuing some of those sharp losses. That's also feeding into some of the currencies that we're seeing. We mentioned the dollar at the top of the show. We're also watching very closely the dollar yen, as you can see on the board there. The dollar actually the yen, gaining some ground against the dollar, trading closer and closer to that 155 level, and the dollar continuing to weaken. And we're waiting to see potentially how that plays out as we inch closer to that BOJ decision on Friday, where we're expecting policymakers to hike, of course, coming after we did see a cut from the Fed last week. Bitcoin also on the board, continuing to fall with other risk assets down just about 0.3% there, dropping below $86,000 for the first time in 2 weeks. A key level to watch will be 74,400, which was a 2025 low that we saw for the cryptocurrency back in April around Liberation Day. And we also have Brent crude on the board, down just over 0.7% there, as you can see, trading at about $60.13 a barrel, as traders continue to assess really what the reality and the feasibility of a ceasefire between Ukraine and Russia actually looks like. And let's just stick on oil for our terminal chart and try to figure out where oil goes from here. A deal to end the war could potentially lead to the U.S. relaxing sanctions on Russia, potentially paving the way for fewer curbs on Russian crude flows. But that would happen into an already oversupplied market. We've talked quite a bit about supply and demand dynamics into 2026, and we are seeing Brent crude and WTI this morning or today already quite a bit weaker. So a key level to watch as this terminal chart is showing. Let's though zoom in on how markets in Asia are faring. Min Lo is in Hong Kong for us. Min, what are you watching?
Yeah, I'm zooming in on the Chinese market because we're seeing quite a sell-off onshore here. And I'm taking a look at Hang Seng Tech. You can see we are approaching close to 20% drawdown from the October high. So we are on bear market watch territory. The level to watch is 5346. We are just 2 percentage points away from there. And that would erase all the gains that we had seen since August of this year. Yes, year to date, we're still seeing gains, but still not a great way to end the year, especially if you consider some of the other onshore indices. The MXCN China also already likely to be on correction if we continue at the same momentum that we are right now. Depending on where we close, the Hang Seng China index also could be set for correction, and it continues to be the weakness in the macro data that we got yesterday. Some economists calling it the ugly November data that seems to be feeding into the pessimism here, as well as the underwhelming signal from policymakers so far about upcoming stimulus. But we're also watching the yuan because we're seeing the fourth consecutive session of gains in the yuan, and that appreciation trend is also tracking a gain in the CPI as well. And this does give the PBOC a bit of a room, right, to allow the yuan to appreciate, because some are saying that a stronger yuan is going to worsen deflation. But on the flip side, there's an ongoing debate onshore as well. Many economists calling for a stronger yuan because it would reduce imported inflation. It could raise purchasing power and lead to that recovery in the consumption space. So certainly something to watch. Most economists expecting the yuan to hit below 7 next year, although Morgan Stanley still thinks that over the next 12 months, the yuan could be pretty flat at the 705 handle or so.
Min Lo in Hong Kong for us. Min, thanks so much for walking us through that chart. Let's continue on with the markets conversation with Mark Cudmore. He's our MLive executive editor in Singapore. Mark, no one better to talk to than you today. As Min and we were just walking through, quite an ugly day in the markets right now. How are you interpreting some of the price action that we're seeing? Is this really all in anticipation ahead of this economic data print that we're getting in the U.S.?
No, I don't think it's so much driven by that. I think a lot of this is essentially de-risking as we go into the low liquidity season after what's generally been a strong year for most financial assets. So we're going to that time of year where technicals start to take over a little bit. We're breaking some moving averages. It's an incentive for people just to take some profit, take some money off the table after it's been a tough maybe month or so, but it's been pretty good for most of the year. So I think that's the main driver right now. The jobs data today, I think, will matter a lot in the short term because, you know, we did have that gap in data before, so people are dying to see what the situation is, especially after Powell said, you know, that he's worried that the jobs data is worse in the US than the headlines were showing. But at the same time, he also pointed out that this print today is going to be complicated by some technical details. And therefore, even though people will get very excited in the short term, I think we'll have moved beyond it a week from now. We'll have dismissed it. So I don't think that's the bigger driver here. I think the fact is the end of the year is going to be tough from a technical point of view. But then in 2026, the macro drivers will take over again. And the structural macro drivers are still pretty supportive.
Mark, how should we interpret then some of the moves as far as currencies go? Minmin was just walking us through the yuan. We were talking about dollar yen ahead of the BOJ. Are you anticipating a bit more volatility and a bit more downside for the dollar in particular?
I've been looking for more FX volatility for about 13 years. Quite disappointed in that front. But, you know, I do think we'll get a little bit more short-term volatility into year-end. I think the Bank of Japan won't matter too much. In fact, you know, my kind of base case assumption for the Bank of Japan is that they hike, they underwhelm in promises of future hiking cycle, and that the yen probably continues to weaken. I tend to be a structural yen bear. On the flip side of that, though, I don't think it matters just too much about the dollar. The dollar is probably the bigger component here, and particularly when it comes to the dollar yuan, you've got to remember that's really just a low beta Bloomberg dollar index trade. It doesn't really say much about the yuan. In fact, the yuan, in terms of its on a trade-weighted basket, is having its worst year since 2016. That makes sense because it's largely pegged to the dollar, and the dollar is having its worst year since 2017. So the yuan is appreciating against the dollar this year, but it's weakening against most of the trade currencies, particularly against things like the euro this year. Now, it's strengthened in recent months, and I think that is a nascent theme that is starting to take over. But if you're looking at dollar yuan, that's really about your view on the dollar. As for dollar yen, yes, of course, Bank of Japan comes into play this week. But I don't think, again, that's going to be the macro driver. It is much more the bigger picture dollar view. For me, I'm biased to think the dollar depreciates in 2026, but it's still a very uncertain picture.
Wow, Mark, a bit negative there, I'm just going to say. Let's just finish, though, on potentially the next macro driver you're anticipating. If it's not the BOJ decision to come, of course, we are moving into a season, the festive season. What do you see as potentially the next catalyst for a bit of a correction or some shifts or rotation in the market?
I think that the bigger shift is as we go into January, I think stock markets will rebound at some point, and I think we're going to see fresh highs in global stock markets next year. The macro backdrop is still quite positive. The Fed is providing easier monetary policy than orthodox economics would suggest, so that's supportive. The US administration is determined to kind of juice up asset prices ahead of the midterms. Most of the big nations in the world are still providing fiscal stimulus, whether it's in Europe, in the US, in China, in Japan. So generally, we're getting a good driver for asset prices. And on top of that, we're still in the inflation stage of the AI capex bubble, which should drive stock prices to higher highs next year. So I think that's the next big driver is that at some point, after we kind of get through this low liquidity period, after we get a bit of a clean out from these stale positions, that maybe at some point, I mean, early January, mid-January, who knows exactly, we'll kind of get the next buy the dip phase and we'll see a bit of a bounce in equities for a few months. At some point, because AI is still the biggest theme out there, at some point the AI capex bubble bursts, and that will be very problematic. But I think we're many, many months away from that. I'm looking as the kind of the very earliest timeline as being April when we get first quarter earnings results, but it could be much, much later than that again.
Wow. Well, hopefully we have you on hand to walk us through it all. MLive Executive Editor Mark Cudmore, thank you so much for walking us through all of that. Really great to get you on the show. Thanks so much. Let's turn to South Africa now. South Africa's central bank is planning the biggest overhaul of the nation's cash system in decades. The central bank is set to create a cash management company, roll out white label ATMs, as well as tighten oversight of how money circulates to make it cheaper and easier to access. Joining me now is Bloomberg's Pranisha Naidu, who's also the author of this story. Pranisha, first overhaul in decades. What exactly is this cash smart strategy looking to achieve for the central bank?
Jen, thank you for having me this morning. Well, the central bank has been embarking on a strategy to boost digital payments for the last 2.5 years. And as that digital payment strategy bears fruit, they've realized that it costs a lot of money to actually circulate cash through the economy. So the new Cash Smart strategy is aimed at reducing the costs of moving physical cash through the country. As you said, they're planning to establish a cash management company, which they think all the commercial banks that are responsible for moving about 90% of the cash through the economy have a stake in this company and help to move that cash through the economy more fluidly. They're also looking at white label ATMs. Now, presently, all ATMs in South Africa are owned and operated by banks and are branded as such. And it's very difficult for consumers to use ATMs that belong to other banks without facing disloyalty fees. Part of the move to roll all the ATMs into this cash management company and have them all as white label is to allow consumers, especially those in rural areas where they face about 5 times as much in costs of cash and have limited access to digital payments options, to use these ATMs much cheaper and to make it more accessible.
So this could make it, as you mentioned, Pranisha, more accessible for consumers. But for those lenders and the retailers who, own some of these ATMs, what are potential effects for them and the costs that could come with this proposed strategy?
So at this stage, the costs are still being calculated. But what we can say is that banks do make quite a bit of money from the transaction costs for people using the ATMs. And if those costs fall away, that'll affect their income. There is also an indirect subsidy that the central bank levies or gives to those that hold and circulate cash for them in the economy. And that's about 480 billion rand a year. And that's likely to be removed as well. And that will also bear on some of the profitability of these private players such as banks.
So we'll wait to see how that plays out. Really fascinating story. Bloomberg's Pranisha Naidu in Johannesburg. Pranisha, thanks so much for that report. Now to Australia. Australian authorities say homemade Islamic State flags were found in a vehicle registered to one of the gunmen that attacked a Bondi Beach Hanukkah celebration on Sunday. At least 15 people were killed in the terror attack. As more details on the father and son gunmen emerge, officials in Manila say the pair traveled last month to an area of the Philippines where Islamic State-aligned groups have operated. Now, coming up, Nasdaq seeks SEC approval for 23-hour trading next year. The details on that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Cape Town. Nasdaq is looking to extend trading on its stock venues to 23 hours during the work week. The second largest U.S. exchange has asked the SEC for approval to add an extra trading session from 9 p.m. to 4 a.m. ET. For more, we're joined by Catherine Nye, our senior markets editor in Hong Kong. Catherine, what would be the benefits of this from the second largest exchange in the U.S. if we do, in fact, see some of these changes take shape?
Well, I think that this move, this ask, for regulatory approval is something that we've actually seen as a trend through markets kind of throughout the world and exchanges where they are moving increasingly to longer trading hours out of demand. But also it really just establishes sort of the U.S. sort of trading as a place where people are quite interested in it. It improves liquidity. People want to trade, especially some of these kind of high beta hot tech stocks that we've seen this year. I mean, there are markets around the world, lots out here in Asia, that are interested in trading the likes of the Nvidias of the world, and so this allows them sort of better access to it instead of having to sort of stay up overnight to do so.
So that inevitably would mean round-the-clock trading. I mean, you mentioned there's already global demand. How do you think this would take shape then globally? Would we continue to see more and more indices maybe moving to the same thing?
Yeah, well, I mean, for one, it means a lot more people who are tired because they're not sleeping as much. But sort of in light of how this works, I mean, one, I think that one of the concerns and risks here is that it means that people have less time to digest headlines in real time, right? When you see kind of a headline hit the wire, people kind of think about and weigh the pros and cons, especially when the U.S. market is shut. And this means that people are going to be much more reactive, which could probably cause some volatility. There's also questions in terms of pockets and windows of times, whether there's going to be enough liquidity, whether big institutional investors are going to want to trade off hours. But in general, I think that this really increases just the liquidity overall for these U.S. markets. We've seen this year, there's been kind of record numbers of, stock traders from, Korea and Southeast Asia who've all been buying U.S. stocks. I mean, you've got a lot of fans in different parts of the region. And so this actually, I think overall, it's probably beneficial to overall liquidity. But there are definitely some risks and questions in terms of pockets of volatility that people are worried about.
So when will we know whether or not this is actually going to be implemented?
There's a long list of regulatory changes and back ends that need to happen, right? You need to figure out how the clearing system is going to offer sort of pricing and a way in which it's transparent. There's a lot of systems in place. Brokers need to figure out how they're going to man these systems and off hours and things like that. I think the expectation right now is that it could be ready for extended trading in the third quarter of 2026. So there's still some time. People can still work out their work schedules a little bit. But I mean, we've already seen just in a lot of exchanges around the world right now, they're offering sort of alt exchanges that offer kind of extended trading hours. And so this will probably be a gradual process until Q3 next year.
Wow. Potentially catch up on sleep before that starts. Catherine Nye, our senior markets editor in Hong Kong. Catherine, great reporting. Thanks so much for joining us. Now, coming up, we take a look at one of Saudi Arabia's most powerful business dynasties run by women. We'll bring you that story next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jennifer Zabasaja in Cape Town. A Saudi family empire with global reach is emerging as a major force in international finance. In today's Big Take, we look inside the Olayan Empire, where sisters Lubna and Hutham Olayan have transformed their family conglomerate into a $50 billion force with influence, stretching from Wall Street to Riyadh. For more, we're now joined by Bloomberg's Abir Abu Omar, who also helped dig into that story. So, Abir, you detail how these sisters are behind this sprawling empire, but maybe let's just take a step back at the significance of the Olayan's family influence. What can you tell us there?
Good morning, Jen. So yes, perhaps the way we set out the story is the best way to showcase the sisters' influence, actually the group's influence. And the way we initiate the story is by bringing the banquet that President Donald Trump had thrown Crown Prince Mohammed bin Salman in November last month. And sat next to the world's richest man, Elon Musk, was Lubna Al-Olayan, who is now the chair of Al-Olayan Group. That just shows how significant she is, because there was a select group of women that were in the official delegation, and Lubna was one of them. But let me run you through some of the numbers, Jen, and perhaps that tells the story. So at Olayan Group, what we know and what we have reported on is that their wealth, according to our estimates, is about $50 billion. But according to some of the people we had spoken to, that number could actually be higher than $100 billion. But because of the sisters' appreciation for their privacy, the actual numbers are not yet known. We are, in fact, adding the family's pool of wealth into the Bloomberg Billionaires Index for the first time this year. So their stakes include about $1 billion in BlackRock, about $1.5 billion in JP Morgan, some stakes in Alphabet and Microsoft as well, along with some of their domestic business. For example, they bottle Coca-Cola in Saudi Arabia. They also have ties with Oreo and Colgate, and they also service oil fields. But essentially, when it comes to the sisters, we know from an interview that Hatham had done about a decade ago that they don't really like the limelight. And I quote her here. She said they don't like to do things in excess, and they're pretty frugal. And that is what we know about the sisters in terms of their influence, their ties with Wall Street. Lubna is quite close with BlackRock's Larry Fink. And that just gets to show you the kind of power dynamics and the kind of powerful people that they merge with during their business ties.
And Abir, I also found it interesting in the reporting just potentially how intertwined they are into even the kingdom and what we're seeing in the kingdom. What would you say sets the sisters apart in the business landscape within the kingdom that is traditionally been dominated by men?
Sure. So, I mean, I bring back a conversation that I witnessed in Riyadh earlier this year with Lubna sat at the FII back in October with the likes of David Solomon and Larry Fink, as I had mentioned. And she was talking about her experience as a woman in the kingdom. So both the sisters had grown up at a time, took on the business from their father, Sulaiman, who started the business in the late 40s. And they both took on the conglomerate at a time where Saudi women didn't really have a lot of rights. As a matter of fact, they grew up at a time where Saudi women had to get male guardianship to even attain passports. But they still built out the business into what it is right now. You know, one thing that we reported on in the story is their close ties to the royals in Saudi Arabia. And I bring back the 2017 jailings of prominent people in Saudi Arabia, including Prince Al-Walid bin Talal at the Ritz-Carlton, if you remember, Jen. The Olayan family seemed to escape the jailings that had extracted billions of dollars from some officials and business people in Saudi Arabia. So, and again, you can tell from the official delegation visit how important they are.
Yep. Abir, it's a fascinating story. Thanks so much for bringing us your reporting. Bloomberg's Abir Abu Omar. And you can read the Big Take on the terminal. Just type in NI Big Take, go. That is it for Horizons Middle East and Africa. Tune in to Daybreak Europe. That's next.